been a spooky time for markets. October has been a bad month in the stock market in general, and last week didn't help. The S&P 500 is down 4% for the month of October so far, and in the last 9 trading days, down almost 6%. The Nasdaq is down 4.4% and 6.8% in those periods. The Russell 2000, don't even ask, down 8.3% for the month, 6.4% in the last 9 days. All pretty tough. What's going on? A popular explanation is that bond yields are rising, which does a few things. The Treasury 10-year is up 5.9% this month in yield and up 4.1% in the last 9 to 10 days, yielding almost 5%. This does the following things. First, it's a signal that markets are starting to believe the Fed actually won't cut rates anytime soon, that we're higher for longer, which has its good part because it means that the economy, according to the Fed, is going to hold up and can afford higher rates. But that also places more strain on the economy because it becomes more expensive to borrow money. If it's more expensive to borrow money, the companies that have debt and will have to pay it off soon are going to have to take out new debt at higher rates, or they just have to pay higher interest already on their debt. Then there's the problem of if you're an investor, you can now invest in risk-free rates for 5% or even more. On a short-term basis, short-term treasury bills, I am finding yields above 5% on an annualized basis. If I can get that, then if I'm going to invest in a risky stock, I have to have a good reason. I have to expect that I can earn a decent amount more than 5% for that to be worth my time. So there's a competitive situation for stocks where investors can get risk-free returns for over 5%, and there's a real pressure on companies. But I think there's a little bit more to this going on than just the treasury yields going higher. Last week, a lot of the biggest companies in the world reported earnings. Google, Meta, or Facebook, Microsoft, and Amazon all reported earnings. They are 4 parts of the so-called Magnificent Seven, which I'll talk about in a second. Have a look at their stats and how they performed in their earnings. Those numbers are pretty good. Strong operational performance, year-over-year earnings growth can be a little bit finicky, but all of those numbers are really strong. At the same time, the results last week from a stock perspective are mixed. Amazon and Microsoft went up, Meta and Google went down. Google or Alphabet quite a bit down. And you can't just point to valuation as the reason for this. Amazon and Microsoft are actually the most expensive companies on classic valuation metrics as compared to Google or Meta. At the same time, one thing that's worth keeping in mind is that all of these companies have seen their stock rise quite a lot so far this year. And because they're the biggest companies in the world and they're so invested in and so followed, along with the rest of the 7 that we'll talk about in a second, the earnings event in and of itself isn't necessarily as big a deal as it is for other companies. It can move the needle, as it obviously did with Google, but there's so much coverage of these companies that an earnings event may just be the latest incremental data point. It's worth thinking about what I just said earlier with the 10-year yields. Most of these companies have really positive, cash-positive balance sheets, so they actually benefit from higher interest rates because they make more money on the cash they have while their debt is locked in at lower rates. So it can't just be that. And the Magnificent Seven has been a hot topic because it's an easy way to explain what's happening in the stock market as a whole. The rest of the companies are Tesla, Nvidia, and Apple, and mathematically they account for a large part of the S&P 500 and the Nasdaq 100 in I think all of those cases, and a large part of those indices rise this year. Anybody who doesn't own those companies can then point to those companies in this trend and throw up their hands and say, market irrationality. Everybody's just charging to the biggest companies in the world. They're super expensive, and that's the only reason that my stocks aren't doing well. I think that's an exaggeration in my depiction, but also I don't find that. I only own Apple of those companies, and while I've had a tough month myself, worse than most of the indices, for the year I've held up okay. So I don't think it's just the Magnificent Seven that's driving everything. But it's always worth keeping that context of stock performance and operating performance and valuation in mind when we try to understand what's happening with stocks. But let's zoom back out by zooming into another company to better explain what's going on. Thermo Fisher reported earnings last week. This is another interesting case. This company is $170 billion in market cap, just about. It is a S&P 500 component, so it's a big company. We're not talking about some small cap. It's a life sciences company. Life sciences, what they do is they sell products, services, tools, equipment to pharmaceutical companies, to hospitals, to research labs, to help them research, treat, take care of patients. It's a very interesting field. It's a field where companies can develop meaningful competitive advantages because their customers can't really mess around. They can't go cheaper. If a trial fails because they tried to save a little money on their syringes or what have you, they're going to feel like real idiots. So these companies get entrenched. They get really interesting competitive power, pricing power, and so on. And Thermo Fisher is considered one of the best companies in this space. I'm still learning about it, but that's my general impression. Thermo Fisher is one of the good ones and a leader. They reported earnings last week, and they weren't great. When a company reports earnings, market is looking at three things generally. How is the revenue as compared to expectations? How are the earnings from the last quarter as compared to expectations? And then how is the company's outlook or expectations, both in a quantitative revenue and earnings expectation, and then in a qualitative, how they talk about things as compared to what analysts had already expected. Thermo Fisher was mixed to bad in those metrics. Their revenue missed expectations. Their earnings for last quarter beat expectations, but then their outlook missed expectations and went lower than what they had said previously. They said, we only expect to grow this year revenue at 1% on an organic basis. Organic meaning once you filter out acquisitions or anything that you can't compare from year to year. They also put an initial line in the sand for next year saying, we also expect about 1% is a good starting point for how you think about next year for us. All of which is to say, Thermo Fisher isn't growing very fast. They're not going negative, they're not growing very fast. One of the interesting pieces of context for life sciences, which you could probably think about, is COVID. COVID led to a ton of investment in biosolutions, in vaccines, in treatments, and so on. Really rapid money coming in to try to solve the pandemic. And as a result, that boosted a lot of these companies. That's still weaning off. That the hangover from that is still coming out. As there's not any fresh investment in that sort of thing, and we're comparing to years where there was fresh investment in these tools, equipment, services, and so on, these companies are facing tough comparables and they're still getting out of them. That's one thing that's going on in life sciences. Thermo Fisher's management did make the point that the macro environment is a problem. They used the adjectives challenging or volatile 12 times by my count in their earnings call to explain the macro environment. They're saying it's tough out there. We think we're doing better than everybody else, but that's the reason we're not doing great, because there's just not a lot of demand for our services as compared to what we might expect or to just continual growth. That's part of the problem. But again, valuation is also something that I think is worth thinking about. By my numbers, Thermo Fisher trades at 28 times trailing earnings. It's said to be trading at 20 times expected earnings for this year and next year, more or less. But I think those are non-GAAP numbers, so they're a little bit adjusted. I prefer the GAAP numbers. 28 times earnings is a GAAP basis for the last 12 months. On a free cash flow basis, it's trading at 31 times. That means for the free cash flow yield that you get out of shares, you're getting about 3.5%, as compared to that 5% number that I used earlier from treasury bills or treasury bonds. You're getting less than you would out of a bond. Of course, it should grow over time, but we've already said it's not growing very fast. And I haven't factored in Thermo Fisher's debt yet, which isn't terribly high, but it's somewhere around $30 billion in debt, which is a little less than 20% of its market cap. It's not terrible, and I would imagine that the interest rates aren't super high, but that's a real number. That's something that's also worth factoring into the valuation. Valuation is what I would call quite healthy. Reasonable minds can argue about what it should be. Thermo Fisher is considered a leader in its field, and it's a field that's very attractive and that has that entrenched competitive power that I talked about, and that tends to attract higher multiples. but it's not cheap, I would say. It's more expensive than the S&P 500, and we'll put it in a historic context. It's not a screaming bargain. For all that, Thermo Fisher has dropped 7% last week, 22% for the year, and is quite a bit off of its highs. Again, does this mean that the market is in a terrible situation, or where does that leave us? Valuation is sort of like gravity. In the absence of any other story to buoy your stock, like AI, for example, which may or may not explain why Microsoft and Amazon went higher, without anything like that, or a reason to believe in strong, outsized growth, valuation will usually drag stocks down. Let's look at Thermo Fisher again. On a 10-year basis, its stock has done really well. 340% returns before you even factor in dividends, way ahead of the S&P 500. It's been a winner. At the same time, it went really high during the pandemic. It's still kind of working off that excess stock performance. And if you look at its price to earnings ratio, as I said, it's more or less in the classic range it's had for the last 10 years. It's now nearing the lower end of its range, which maybe makes it attractive, but it's not as if it's suddenly trading at 20 times earnings when it used to trade at 30, or 10 times earnings when it used to trade at 20. It's still in its historic range. So it's hard to make some sort of screaming argument for a buy. Market as a whole, ignoring valuations at the market level, let's just step back and remember. The S&P 500 is up more than 7% this year. The NASDAQ is up almost 21% this year. The Russell 2000 has a different story, and that may be worth its own exploration why small caps continue to struggle. And as I've said with Thermo Fisher, its story is different for this year, though on a longer term horizon, not so different. All of which is to say that we can always step back and take a look at context. Valuation is a form of context. Historical multiples and historical behavior is another form of context. And weird events like COVID are important forms of context. It's not enough to just take numbers. We have to understand what is going on with the numbers, what would explain it. That's where our analysis of companies is also really important. A bad month will happen. And in some sense, it's been a bad 2 or 3 months for the market. And certain indices are in correction and things have fallen off quite a bit. But when we zoom out, it's been an interesting and positive year for the market as a whole. I don't think it's just because of the Magnificent Seven. And when we go back over the years and decades that we want to invest, what's happening in October is probably not going to stand out very much. Hopefully that'll be helpful for you as you're trying to manage what you're doing with your stocks and your investments in the months and years ahead. My name's Daniel. This has been the long and the short of the markets, a new thing that I'm trying out on my Short Investing Guide channel, where you can get longer term educational videos on how to invest. Subscribe to this channel to get more of that. Check out shortinvestingguide.com for my posts. Thank you for watching, and I hope to see you if and when I do this again.